goods and services tax in Singapore. Please read up more after this. Without further delay, let me share the materials. Now, in today's webinar, there are certain objectives that we would like to achieve. We would like to explain the requirement for GST registered business, identify and explain the different types of supplies, which includes standard rated, zero rated, and exempt supplies. Explain how GST is accounted for and administered, and explain the condition for input claims, including introducing the de minimis rules. Now, GST is a broad-based tax on local consumption of goods and services, as well as importation of goods into Singapore. The burden of GST is borne by the final consumer. The GST works under a self-assessment system, and the onus of determining the tax liability rests on the taxable person making the supply. From an end-to-end perspective, you can see from this diagram that the consumer is the one that is forking out the GST, and the GST that's being paid will eventually flow all the way to the right-hand side to the government. And this is where, for example, when a consumer pays GST to the seller will act as an agent to the government, collects the GST, and pay it to the Inland Revenue Authority of Singapore, who will then collect the GST and forward them to the government as the government revenue. Now, a simple example here on how the GST works and the introduction of input tax and output tax, where GST is a creditable mechanism where the person who incurred the GST or paid the GST, and if it's a GST registered person, would be able to claim the GST back from the government. So in this case, we will run through a flow where the supplier sell the goods to the manufacturer and then so on to the retailer and to the consumer. In this example, you will see on the left-hand side how much of the charge or the fee belongs to the business as income and how much of it belongs to the Inland Revenue as GST revenue. Now, in this case, the supplier charged $1,000 on the goods that's being sold to the manufacturer. The $1,000 that's being charged would attract GST of 9% and the GST of $90. So therefore, the manufacturer would actually pay the supplier $1,000 and $90. When the manufacturer pays the $1,000 $90, there is a component of GST which is $90, and that to the manufacturer is an input tax. The input tax can be claimed back from the government when it files its income tax return. Now, when the manufacturer continues to sell the goods at $1,500 to the retailer, the manufacturer, being a GST registered person, will have to charge GST at 9% on the $1,500, which gives us $135 of output tax, which is the tax that has to be paid to the Inland Revenue. So on filing of the GST return, the manufacturer will have to take note that the $90 can be claimed back from the government, $135 has to be paid to the government, and therefore the net amount to be paid to the Inland Revenue would be at $45. Now, moving on to the retailer would have paid $1,500 to the manufacturer plus a GST of $135. The $135 will then form the retailer's input tax, which can be claimed back from the government. When the retailer sells the goods to the end consumer at $2,000, the retailer again have to apply 9% on the $2,000 and charge $180 of GST. When it comes to filing of GST return for the retailer would want to ensure that they claim back the $135 from the government and pay $180 that they have collected as GST to the government as well. And therefore, at a net position, the retailer would have paid the inland revenue $45, which is $180 minus $35. Now, when it comes to the consumer, the end consumer who is not a GST registered person would have to pay $2,000 to the retailer plus a GST of $180. Now, because the consumer is not a GST registered person, there's no avenue for the consumer to claim the $180 of GST back from the government. And therefore, the GST is borne by the consumer. Now, linking back to the diagram that I have shared before this slide, you realize that this is a case, an example, where the GST is borne by consumer and this GST of $180 is being shared in different layer and is given to the government as GST revenue. So how do we account and communicate all the GST that is being collected and paid to the inland revenue? And therefore, as a GST registered person or business, you must submit a GST return to the inland revenue 1 month after the end of each prescribed accounting period. And this is usually done on a quarterly basis. Now let's talk about output tax. And this is an area where we will have to charge GST and pay the GST to the government, to the inland revenue. So how do we determine whether should I charge GST and how much should I be charging? When charging GST, we look at a few categories, and that includes the type of supply, the time of supply, and as well as the value of supply. Only when these 3 items are identified, then we know when and how much of GST to be charged to the customers. Let's take a look at where the authority to charge GST is given. The authority to charge GST is given by the GST Act. And it states that GST is chargeable when all the following conditions are met. When that transaction, that sales, constitute a supply of goods, and the place of supply is made in Singapore, the type of supply is a taxable supply, and it is made by a taxable person in the course or furtherance of any business carried on by him. When all these conditions are met, then GST has to be applied. Question then is, what is a supply? How do I know that a transaction, that sales, is considered a supply that may attract GST? In general, a supply of goods or services refer to anything done in return for a consideration. Therefore, a supply exists if the following elements are present. There is a consideration. It may be in money or in kind. The consideration is in exchange for something done. Therefore, a refundable deposit is not a supply because there's no exchange for anything. A deemed supply, on the other hand, may not require consideration. And the deemed supply is governed under the second schedule of the GST Act. The deemed supply is one where a transaction don't squarely fall within the condition which has been shared just now, where there is a consideration and there is an exchange for something done. If one part of it is missing, strictly speaking, there is no supply. But second schedule of the GST Act can deem certain type of transaction to be considered a supply, which then falls within the ambit of the GST Act, and therefore GST may be applicable. An example of deemed supply that is mentioned in the second schedule of the GST Act is a gift that is more than $200. And it's stated there that business sample is not deemed supply. Also, a transaction of non-business or private use of business assets can be deemed as a supply. When we have ascertained that a transaction constitutes a supply, then we need to ask the second question of what type of supply is this? The type of supply will then determine whether that transaction requires to attract GST or not, and the percentage of GST to be applied. So we have different types of supply. There's a category for taxable supply where it includes standard rated supply. And these are supply that are made in Singapore, which attract GST at the prevailing rates of 8% or 9% in 2024 onwards. There are also within taxable supply, zero-rated supply. And these are supply relating to exportation of goods and international services, and the GST applicable is 0%. There are some non-taxable supply where GST is not applicable, and this includes exempt supply. Exempt supply are a list of transactions that are listed in the fourth schedule of the GST Act. An example of it are sales and lease of residential property and certain financial services. There are also the last category of not a supply or out of scope supply, which means that that transaction is not described under taxable supply. It is also not described under exempt supply. And this type of supply is considered out of scope. And in short, it is a supply that outside the scope of GST. Example of this would be third-party sales, where the shipment of goods do not arrive or bypass Singapore. Now, to determine the type of supply, we generally split the transaction into either a provision of goods or a provision of services. Let's talk about provision of goods. If we identify and categorize a transaction to be a provision of goods, that means I'm selling something. Then to determine the type of supply, we look at the beginning location of the goods and the ending location of the goods in short. So take this diagram as an example. A sells to B, assuming A is in Singapore, B is outside Singapore. The beginning location of the goods is in Singapore, and the ending location of the goods after the transaction is outside Singapore. And this is considered exportation, where the type of supply is zero-rated supply. When B, which is outside Singapore, sells goods to C, which is also outside Singapore, assuming the beginning location of the goods is outside Singapore at the beginning, and the ending location of the goods is also outside Singapore, then this will be considered as out of scope. There is no supply because it is not made in Singapore. Now, moving on, when C, which is outside Singapore, sells goods to D, which is in Singapore, the beginning location of the goods is outside Singapore, the ending location of the goods is in Singapore. This is considered importation, and standard rated supply applies, and you'll be applied on importation by custom. The rate to be applied would be 9% from 2024 onwards. Lastly, when D sells the goods to A, where D is in Singapore and A is in Singapore, the beginning location of the goods is in Singapore, the ending location of the goods also in Singapore. In this kind of situation, this transaction is made in Singapore and standard rated of 9% applies. So this, in a nutshell, when we look at the provision of goods transaction, we tend to follow the location of the goods at the beginning and at the end to determine the type of supply in general. How about the provision of services? When we identify the transaction to be a provision of service and not a provision of goods, then in general, we will standard rate the supply of service, unless it is an international service that is listed under Section 21(3) of the GST Act. So as you can see, there's different type of supply. There's a zero-rated supply for exportation, but zero-rated supply also applies for international services, so goods or service. When we look at goods, the exportation of goods, we look at the beginning location and the ending location of the goods. For international services, whether to zero rate, we look into Section 21(3) of the GST Act to see if the Act described the transaction that is in question. If yes, then zero-rated supply is the way to go and 0% GST is applied. An example of international services under Section 21(3) is Section 21(3)(j), which states that you can zero rate if the transaction is under a contract with a person who belongs in a country outside Singapore and which directly benefits a person who belongs in a country other than Singapore and who is outside Singapore at the time of the service are performed, or a registered person who belongs in Singapore. There are many subsections under the 21(3) of the GST Act. So if you're interested to see how a type of transaction for the provision of services is to be zero-rated, please take a look at 21(3). There's another category of supply called an exempt supply. An exempt supply generally does not attract GST. The fourth schedule of the GST Act specifically exempts certain supply from GST. This includes the provision of financial services, sales and lease, the annual value of a residential property, and the importation and local supply of investment precious metal. Do note that the furnished lease, where it includes furniture and fittings, the furniture and fitting, strictly speaking, are not residential property. They do attract GST. And how do we then identify the portion of the rental that belongs to the rental of furniture and fittings? We will usually take the rental minus away the annual value, and that balance is attributable to the rental of furniture and fittings, and standard rated supply will apply. Now, no GST needs to be charged on exempt supply if the transaction is indeed an exempt supply. Some example of common financial services which are considered exempt supply, they include interest income from current or fixed account placed with a Singapore financial institution, realized exchange gain or losses arising from transaction in foreign currency, provision of loans, advance, or credits to employees. Now, if all these different transactions happens within Singapore, it will be considered exempt supply. However, do note that if the exempt supplies are supplied to a person who belongs outside Singapore, then this supply can qualify for zero rating at 0%. In a nutshell, when you look at this and analyze this transaction and you say that this is an exempt supply, but it also falls within the ambit for zero rating, then zero rating will prevail. Going deeper into dim supply, this refers to supplies that falls within the description of second schedule of the GST Act. It is important to understand dim supply because when we analyze a certain transaction, it may, at the outset, has a conclusion that this is not a supply because maybe a consideration is missing, maybe an exchange of goods or services is missing. So understanding dim supply is important because when that transaction at the upfront is not considered a supply, if that transaction is being described under the second schedule of the GST Act, that transaction can be considered as a dim supply. And when it is a dim supply, we then have to move on to talk about what type of supply is this and to apply the GST rate accordingly. Now, an example which was briefly talked about just now is in the case of gift to third party. In the case of gift to third party, this is a case where there is a provision of goods, right? You give, but there is no consideration because you don't charge. You're giving the person an item for free. Now, if you look at the general definition of a supply, this transaction can be argued that it is not a supply. However, under second schedule, it is described that if one bought the gift in the course of business and from a GST registered person, and you give these goods away for free, it is not a supply if the gift is not more than $200. However, if the gift is worth more than $200, then the GST Act would deem that transaction as a supply. And if that is a supply, you would then need to understand and find out what type of supply is this, and you may have to apply 9% GST on the $200 or the market value of the gift. If one bought the gift in the course of furtherance of business and from a non-GST registered person, that means you didn't claim any GST, the GST Act second schedule says that the gift to the third party is not a supply as no input tax was incurred. So there are a few scenarios that are being described under the second schedule, which will make a not a supply to become a supply. So do take note, and you have time, please read it out. Now, after we have determined whether is that a supply and the type of supply, we also want to know the place of supply. Now, this is important because if the place of supply is not in Singapore, it is our scope. So the place of supply is more relevant for services where the supplier belongs in, that is the belonging status of the supplier. So Section 15 of the GST Act says the supplier of services shall be treated as belonging in the country where the supplier has an establishment in that country and no such establishment elsewhere. Or the supplier has no such establishment in any country, but its usual place of residence is in that country. Or the supplier has such establishment both in that country and elsewhere. In two countries, it has establishment, and the establishment which is most directly concerned with the supply is in that country. So these three scenarios, which Section 15 of the GST Act explain, would allow us to determine where the supplier belongs and therefore the place of supply. Moving on to the time of supply. And the time of supply is important because we need to know when to apply the GST and to report to the Inland Revenue. The time of supply is the earlier of issuance of invoice or the payment is received. And the payment here is anything that constitute a consideration. So for example, if you receive a payment on 30th April, but your tax invoice is only issued on the 1st of May, the time of supply is 30th April, which is the earlier of both. And which means that as at 30th April, you need to apply the GST, and the GST happens and need to be accounted for on 30th of April period and not 1st May. Now we talk about type. We talk about the type of supply. We talk about the time of supply, the type of supply. Now we need to know what is the value of supply. The value of supply is important because after we determine the type of supply, whether it's 9% or 0%, we need to apply the GST rate on a value. So for that transaction, we need to determine what is the value of that supply in order for the GST rate to be applied on. So the value of supply here refers to the quantum of the transaction that is subject to GST. It's generally straightforward unless trade-in or some kind of non-monetary consideration is involved. For non-monetary consideration, we need to ascertain using the considerations of the open market value. For import, GST is computed based on the cost, insurance and freight, which is the C value of the imported goods, plus all duty payable to the Singapore custom. Now note that for imported services, they may be subjected to reverse charge. And in that case, you have to charge GST to yourself, which will form input tax to your company. And if your business is one that is fully creditable, then the input tax will be equal to the output tax. Okay, when you charge GST to yourself, that's output tax. When you charge yourself, that becomes input tax. If you are fully credible, the output and input are the same. You have no net impact. Now let's move on to input tax. We talked about output tax just now, which is when and how should we be charging GST to the other party. Let's move to another area of input tax where we are being charged GST, right? Somebody sell us goods or services, they charge us GST. The GST that is being charged to us, we want to claim it back from the government so that it can reduce my output tax to the government. There are rules involved when we want to claim the GST incurred back from the government, and the GST that we paid is called input tax. Claiming of input tax is pretty straightforward as compared to charging, where you have to determine many different items. Claiming of input tax is simply, first, you definitely have to be charged GST by a person. And you have to ask yourself, do I meet the condition to claim GST? If you check that box, you then move on to ask yourself, look, there's a list of transactions that is specifically blocked for GST claim under Regulation 2627. Does my transaction here falls within the listed transaction? Assuming it is not blocked, it's not described in the list, then you proceed to claim the GST back from the inland revenue. And that's how straightforward the claiming of GST is. There's some general rule for claiming input tax. Generally, a supply of goods and services made to or imported by the person claiming the input tax, and the person must be a GST registered person. Okay? Input tax must be paid for supply of goods and services used or to be used for the purpose of any business carried on or to be carried on by the person claiming the input tax. So there must be some link between the input tax and your business. The input tax is attributable to the making of taxable supply or out-of-scope supplies, which would be taxable if made in Singapore or such other approved supply. So again, not just linked to your business, it has to be linked to the business where you make taxable supply. So input tax and output tax need to have some kind of nexus, some kind of connection. When we can identify that connection between incurring GST and charging GST or a link to a taxable supply, the next thing we need to ensure is documentation proof. And therefore, a person claiming the input tax has to maintain a valid tax invoice, a simple tax invoice, a simplified tax invoice, or relevant import permit to support the input tax claim. And after we have that documents to support us, we then have to run through the list of expenses that is under regulation 26 and 27 of the GST general regulation to ensure that they are not blocked. Now, what is under regulation 26 and 27 of the GST regulation, which therefore are specifically called out to be blocked for input tax purposes? This includes club subscription fee, medical and accident insurance premium, medical expenses, unless it is mandated by law or union agreement, benefits provided to family members, relative of your staff, costs and running expenses of private registered motor cars, expenses incurred on company's car of which the certificate of entitlement has been renewed or extended on or after 1st April 1998, expenses incurred on rental car hired, any transaction involving bettings, sweepstakes, lotteries, fruits machine, and games of chance. When your transaction is being described under this list, the GST that you have incurred will not be allowed as input tax. There are certain relief under the input tax scheme, and one of it is bad debt relief. Where a trade debt is written off as bad, the supplier may apply for bad debt relief for return of the output tax previously accounted for and paid. So this is a case where in the past, you sell something to a customer, you charge the customer GST, you paid the GST to the inland revenue out from your own pocket. Your customer runs away, your customer disappears, cannot pay you, may be liquidated, it becomes a bad debt to you. You cannot recover the amount that you have charged them, which includes GST. The inland revenue allow a bad debt relief so that the GST that you cannot collect from your customer can be claimed back from the government. But there are certain conditions that has to be met, and that includes the supply of goods or services for consideration in money and have accounted for and paid GST on the supply. You have paid for it before. Return off the whole or any parts of the consideration for the supply as bad debt. A period of 12 months beginning with the date of supply has lapsed, or the debtors has become insolvent before the period of 12 months has elapsed. So you need to wait, right, for a certain period to ensure that you really cannot get the money back. Then you can go under this relief to get some relief on the GST that you have paid on the bad debt. You have taken reasonable steps to recover the debt. The value of supply is equal to or less than its open market value. The ownership of goods must have been transferred to your customers. And bad debt report, you will report it as an increase in input tax. The recovery report as an increase of output tax in the case when you actually recover the bad debt. There are some GST implication of business making exempt supply. Remember, one of the conditions for claiming input tax is that we have to match the input tax to a taxable supply. However, if the business has partial exempt, is a partial exempt business, that means it generates some exempt supply. Strictly speaking, you cannot claim the full input tax from the government because some of the input tax that is attributable to the making of exempt supply is not claimable. So this administratively will create a little bit of challenge because then you need to be very precise to match your input tax to an exempt supply. Now, of course, if your business make only taxable supply with no exempt supply at all, then 100% of your input tax is claimable. Even though the company or the business may be making a little bit of exempt supply, the Inland Revenue allows business to claim all its input tax, including input tax attributable to the making of exempt supply at the end of any prescribed period if it satisfies the de minimis rules under Regulation 28, or it makes only Regulation 33 exempt supply and is not a Regulation 34 business. So this is a practical approach because if we are so strict, we need to match all the input tax to taxable supply and exempt supply. The part that goes to exempt supply, we cannot claim the input tax. Under the first concession or the first rule of de minimis, the rule allows the company or the business to claim 100% of the input tax, even though there is an exempt supply, provided the exempt supply in question is very small, is immaterial. Now, how much is immaterial? We'll look at it in the next few slides. Or it makes only Regulation 33 exempt supply. So there are certain type of exempt supply that is described under Regulation 33. This type of exempt supply is something that is needed, and therefore input tax in relation to that can be considered as claimable input tax. And we'll talk about it shortly as well. Now, in the case where de minimis rule is not satisfied in any prescribed accounting period, the business may claim only input tax incurred in the making of taxable supply, and this is where you need to split. Input tax that cannot be direct exempt supply is considered as residual in nature, or sometimes we call it a residual input tax, and it has to be a portion. This is known as input tax apportionment. Okay, so if you can do a direct link, we will split it. If there are certain type of expenses that we cannot link to taxable or exempt supply, then we have to put it in together and call it a residual input tax. We got to apportion that amount to taxable supply and exempt supply. So Regulation 28 of the GST general regulation states the de minimis rule. And if one satisfies the de minimis rule, he can claim all input tax incurred, including input tax incurred in the making of taxable supply. But do note that input tax disallowed under Reg 26 and 27 remains as not claimable. The Reg 26, 27, if you can remember, we talk about the whole list of items and transaction that is specifically blocked for GST input tax purposes. Now, de minimis rule. The de minimis rule is satisfied if the total value of all taxable or all exempt supply made does not exceed an average of 40,000 a month, and 5% of the total value of all taxable and exempt supply made in that period. So this is how immaterial, this is the value of immaterial that the law prescribed. Okay, so on an average, 40,000 a month, if your exempt supply is lesser than this, and that value of exempt supply is lesser than 5% of your total value of taxable supply and exempt supply, which is all your supply, then you're fine, right? All your input tax will be claimable, even though you have exempt supply. Now, although the de minimis rule is satisfied in the prescribed accounting period, the same test have to be done again at the end of a longer period to determine whether all the input tax incurred in making of exempt supply in the longer period also satisfy the de minimis rule. This is what we know as the longer period adjustment. And this is required because when we file our GST, we file it on a quarterly basis, for example, and whether can I claim or do I need to split my input tax, I will base on the financial or the GST situation in that quarter only. All right. So each quarter I will do based on the quarter information whether it's de minimis or not. But at the end of the year, we have to do a longer period determination again, where we add all the 4 quarters together and run this de minimis rule one more time to see whether for the full year, do we qualify for de minimis as well. All right, so it doesn't mean that within that quarter or that filing period, you qualify, you always qualify, or vice versa. It doesn't mean that within that filing, you don't qualify at the longer period situation. All right, so you can don't qualify now, but at a longer period, you actually qualify because you have 12 months to play around with. Right, the determining of the longer period is the tax year of the business. It generally refers to 12 months period commencing 1st April, 1st May, or 1st June, right? So it goes 12 months. If you fail the de minimis rule in any prescribed accounting period for that quarter, for example, you can still claim the input tax in relation to exempt supply by making a second de minimis test at the end of the longer period using the longer period. This is as what I mentioned. Okay. If you pass the de minimis rule in any prescribed accounting period, you have to run this longer period again because you may lose the input tax if the determination at the end of the longer period fails the de minimis rule. Now, moving away from de minimis, which is the sort of immaterial exempt supply, let's take a look at the other type of exempt supply which input tax can be claimed. And this is Regulation 33 exempt supply. The exempt supply listed under Regulation 33 of the GST General Regulation are considered to be necessary and integral to the making of taxable supply. Therefore, the input tax incurred in the making of such exempt supply is treated as input tax attributable to the making of taxable supply, subject to Regulation 34 and 35. So therefore, what this has done is make the exempt supply under Regulation 33 as if they are taxable supply. So if they are deemed as taxable supply, then input tax to a taxable supply Regulation 33 supply would then be 100% claimable from the government. Now, businesses is not allowed to claim input tax incurred in the making of Regulation 33 exempt supply if it is a Regulation 34 business or it makes a non-Regulation 33 exempt supply and the value of the non-regulation 33 exempt supply does not satisfy the regulation 35 test. So there are certain things that we need to run through in order to confirm that regulation 33 exempt supply in which the input tax is attributable to, that input tax is claimable. Right, so in the next few slides, we'll talk about what is regulation 34 business and what is the regulation 35 tax. Some example of regulation 33 exempt supply, which is as what we mentioned, needed and integral to the making of in the business when you run your business. And this includes the deposit of money, the receipt of interest in respect of the provision of credit for any trade receivable. So what is regulation 34 business? Reg 33 is not applicable to partially exempt business carry on the business of or any business similar to any of the following listed below under regulation 34 business. And these regulation 34 businesses are generally banks, insurance, and financial intermediaries. Now, assuming you're not banks, you're just a normal company running manufacturing and selling goods, then you would have passed the Reg 34 business test. The next test then we need to subject the regulation 33 exempt supply to is a Reg 35 test. And this is a condition that need to be passed if the person is making Reg 33 exempt supply and you want to claim the input tax in relation to this Reg 33. Now, if you are not a Reg 34 business but mix non-Reg 33 exempt supply, he can claim the input tax incurred in the making of Reg 33 exempt supply only if the value of the non-Reg 33 exempt supply, or which is the real exempt supply, does not exceed 5% of the total value of all the taxable and exempt supply made in that period. So this Reg 35 essentially has a little bit of that de minimis element in it. Is it immaterial enough to ignore? All right. So this Reg 35 essentially has a little bit of that de minimis element in it. Is it immaterial enough to ignore? All right, and the percentage here is 5% of the total value of all your taxable and exempt supply. Are you making that? How much of that non-regulation 33 exempt supply are you making? Okay, if it's less than 5%, it does not exceed 5% of your total value of your taxable and exempt supply, then you will have passed this test. Now, the same test will have to be applied again at the longer period, all right, at the end of the longer period. Now, having said the de minimis rule and also the Reg 33 supply, exempt supply, let's talk about what happens, right, if you fail the de minimis rule. And then we have to move into the input tax apportionment. So if one indeed fail the de minimis rule, which means that you have produced, you have actually quite a sizable amount of exempt supply, then you need to first identify the direct input tax. And this direct input tax are input tax directly attributable to the making of taxable supply, or that amount, they are all fully claimable. There's another type of input tax which is directly attributable to the making of Reg 33 exempt supply. Remember, Reg 33 are the exempt supply that is needed when running a business, that it will happen, and that was deemed as taxable supply. For those Reg 33 exempt supply, the input tax attributable to them will be claimable. Now again, provided that it is not a Reg 34 business and you pass the Reg 35 test, which we mentioned just now. Otherwise, input tax attributable to the making of such exempt supply is also not claimable. An input tax directly attributable to the making of non-Reg 33 exempt supply is not claimable. Now, after you have done that direct allocation, you will come across certain expenses or input tax that cannot point directly to a type of supply. For those type, it's called a common input tax or residual input tax. The residual input tax must be apportioned in the following manner. If it's a non-Reg 34 business and satisfy the Reg 35 test, which means that your Reg 33 exempt supply is considered as a taxable supply, then the recoverable residual input tax will be equal to the total residual input tax multiplied by the value of your taxable supply plus the value of your Reg 33 exempt supply, because now your Reg 33 exempt supply is like a taxable supply. Find the total value, divide it by the value of the total supply, and multiply by the total residual input tax. That is your recoverable residual input tax, which means that you can claim that portion as input tax from the government. Now, if you are not a Reg 34 business, not a bank, but a normal business, but you don't satisfy the Reg 35 test, in this kind of situation, then the amount that you can recover from the residual input tax will be equals to the total residual input tax multiplied by the value of total taxable supply divided by the value of total supply. Now you realize that the part on Reg 33 exempt supply is missing because